Welcome to Oregon Cash Flow Pro. My name is James Barber, and today we're going to talk about annuities. I recently bought an annuity, and I was going to do a video telling you about that, and I will. It'll be coming out soon. But I thought that it needed some proper context and some education ahead of time because I haven't really talked about annuities on this channel. So we'll consider this video Annuities 101. We're going to talk about what they are, the different types that are available, and when they might be a good idea for you to consider. A word of warning, there are a lot of financial advisors out there that hate annuities. As with any products that we have out there, there's going to be haters. You've got people that are advisors in the stock market and they love to meet every financial problem that you have. The solution to it is some type of investment in the stock market. Alternatively, you might have somebody who focuses on investing in real estate, and to them, the solution to your financial problem may be found in real estate. Or we'll have life insurance specialists on the whole life side that might think whole life is definitely going to be the answer to your problem. And our IUL specialists are going to tell you that IUL is the solution to the problem. And there's even people out there that specialize in the annuity space. That's all they focus on selling. And the annuity is going to be the answer to your problem. Now, if you follow my channel at all, you know I don't really subscribe to any of those scenarios where you're going to find the answers to all of your problems in one place. We like to diversify. I like to see some diversification. I think it makes it easier. It's a little bit more complicated to manage, but it makes it easier to ride out any potential ups and downs of whatever market that you're in if we get that diversification that we need. It helps us to sleep better at night. It helps just at its base level that if some area goes bad, real estate market goes down, stock market crashes, our whole portfolio is not going to be affected by it, at least to a degree that we're still able to sleep at night. So with that in mind, we offer this education so that you, who is the ideal steward of your money, has the necessary information to make the decisions that you need on what products you might need to purchase or where you might want to invest or otherwise store your cash and prepare for future retirement or other expenses. With that said, what is an annuity? Merriam-Webster defines annuity as a sum of money payable yearly or at other regular intervals. That's what an annuity is. Now, there's also an annuity product itself that's sold by insurance companies. But an annuity in and of itself is just a string of monthly payments, guaranteed generally for the rest of your life. Might not be. It could just be a regular payments. When we take a lump sum of money and we turn it into a string of payments, that's called annuitizing that cash. So an annuity is just a stream of payments. That's going to be important when I go to my next part of this, because oftentimes when we think about annuities, the products, we're thinking of utilizing them in relation to retirement and helping us meet our retirement income goals. Now, at its base level, I think the government also views them that way because we get tax advantages on money that's inside of an annuity. It gets to grow tax-free. But if you take that money out prior to retirement, you end up paying a penalty, or I should say prior to 59 and a half, you pay a penalty just like that money was inside of your retirement account. It doesn't matter if you own this annuity inside your retirement account or outside of it. It might get treated as if it was your retirement account and you get a penalty if you actually take the money out prior to age 59 and a half. Now, I've been selling annuities longer than I've been selling life insurance. It was the space that I started in working with annuities. And generally, when we look at annuities, we're talking about them in relation to retirement, right? And the way that I was taught to sell them was in relation to a three-legged stool. When we get to retirement, there's a three-legged stool. And this stool of your retirement is built on Social Security, pension, and other savings. This is an article from Investopedia, and it talks about this as being an old phrase. I haven't focused on annuities for a while, so I didn't realize that this was considered an old phrase. But it could also be that Investopedia is also marketplace focused, stock market focused. And I kind of get some hints when I look at and we read this article. But essentially, it tells us it's an old term for the trio of common sources of retirement income: Social Security, pensions, and personal savings. And it says here, one leg of the stool, pensions, has been replaced by defined contribution plans that place the investment burden on the individual. So this article, which I disagree with in this scenario, it says that the pensions in the three-legged stool have been replaced with your 401k or your 403b, your retirement plans. And that's where I would beg to differ. In our employer-employee relationship, pensions have been replaced by that. But that doesn't negate our need for income in retirement. And that three-legged stool, the pension one, the pension represents guaranteed stream of income. That was the value of the pension. Our retirement, it could, if we annuitize those dollars and figure out a way to get guaranteed income from it. But in and of itself, those retirement plans don't replace it as part of that three-legged stool. I do think it's important that we meet our basic income needs in retirement with guaranteed income. It will make it a lot easier in retirement to spend what you need to spend on your necessary living expenses if you know that that money is going to get replaced every single month. There was an interesting analogy that I heard the other day. Imagine you get stranded on a desert island and you've got a bucket of water and there's no other water sources on this island. You're surrounded by salt water. You don't know when you're going to get rescued or if you'll get rescued. So how much of that water are you going to use each day? The answer, as little as possible, right? As little as possible to survive, because that ensures that you're going to be able to survive as long as possible. You're not going to want to use it up too quickly and then you're out of water, you've got nothing to replenish, and you die of dehydration. Now think about in relation to retirement. If we've got money saved up for retirement and you retire and that's all that you have to live on for the rest of your life, and you don't know how long you're going to live, how quickly are you going to spend that money? How much of that money are you going to use each month? Similar to our desert island situation, probably as little as possible. You're not going to feel comfortable spending any more than is necessary. And that's part of the problem. A lot of people get into retirement and they're afraid to spend their money that they saved up because they don't know how long they're going to live and they don't know if they're going to run out of money. Now imagine the scenario that you're on this desert island and you've got this bucket of water, but it's guaranteed to refill every single month or every single day. It's guaranteed to refill. How much are you going to drink? You're going to probably use it all up. Or at least you're not going to be afraid to use it all up because you know it will be back there the next day. Similar situation when we get to retirement. When we get to retirement, if we have a guaranteed stream of income that we know is going to be coming in month after month, we can spend that money without fear that it's not going to be there the next month. This is where Social Security comes in and why it's such a revered program. And it's where pensions have been revered, and now it's where the value of an annuity can be. An annuity can replace that pension. We can take some of the money that we have set aside for retirement and we can annuitize it and get that guaranteed income stream, which gives us the peace of mind to be able to spend that money each month, not on frivolous things, but on things that are necessary for our survival. So when we get to retirement, we want to be thinking about how much do we need to meet our expenses, our anticipated expenses, and oftentimes what we like to say is our minimum dignity floor. We need a certain amount of money so that we can live in dignity throughout retirement. That amount is nice to have with guaranteed income. At its most basic level, that's where I like to view the annuity as helping us get to that point. Now, there are other things that we're going to do in retirement. We're going to have retirement savings that are in the stock market, and we're going to probably have retirement savings, I know I will, in my life insurance policies. I'm going to use those to tap into it, but I'm also going to want that guaranteed income stream. So now that we know what an annuity is at its base level, we know how we like to see it in relation to retirement. What are the different types of annuities that are out there? There's a number of different annuity types out there, and it's important to know that because they serve different purposes. There are different types of annuities to help meet different needs. It's not a one-size-fits-all situation. And this is where you're going to want to have a good advisor. A good advisor will have an idea of where the different annuity types might fit into your situation. Or when we discuss your situation, what annuity type might help best meet your needs right now or a future need. Or maybe it's not right for you in that situation. You're going to want somebody who's experienced and knowledgeable in the different types, as opposed to somebody that only knows one type and they're going to figure out how to shoehorn that into being the answer to your need. So this is a good little list of the different types of annuities. When I just plug into my browser, different types of annuities, and you can see this was generated using the AI. We have, at its base level, just like most of our other options when it comes to finances, we have qualified and non-qualified annuities. Qualified is, it's in a retirement plan. Non-qualified is anything outside of retirement plans. It's after-tax dollars in a non-qualified plan. We have single premium annuities and we have flexible premium annuities. That's pretty self-explanatory. We either pay it in one lump sum or we pay it over time. When we pay for it over time, we're going to defer the income. So this is a deferred annuity. Usually with a single premium, it could be an immediate annuity, but it also can be a deferred annuity. This one basically listed as a lump sum deposit with immediate income because that's the most popular type. When you get into retirement or you get into old age and you have a lump sum of money and you want to annuitize it, a single premium immediate annuity, otherwise called a SPIA, it's the simplest type of annuity to look towards. And those can have guaranteed payouts for the rest of your life. It could be guaranteed for a certain period and then the rest of your life. There are all different kinds of ways that these things can pay out. But we can also do a single premium that goes into a deferred annuity. So it's not just a flexible, but the deferred annuity, a lot of them will allow you to continue funding it over a certain period of time. It might be a year, it could be 18 months. It might even be every year up until retirement. There's a lot of flexibility in these products. The qualified longevity annuity product, also called the QLAC, I'm not too familiar with these ones. They're generally used if you want income later in life, like way later, and you don't want to be subject to RMDs before they get turned on. If I understand them correctly, the QLAC allows you to avoid having RMDs come out of your lump sum before you annuitize it. But the annuitization isn't going to happen until much later than your early retirement years. We've got your fixed annuities, your equity indexed annuities, and your variable annuities. Your fixed annuity, you're going to get a set percentage growth or a payout. It's going to be determined by the insurance company and it doesn't change. It could be a set amount of growth each year or it could be a set payout. Your equity indexed annuity is going to be growth based on the stock market. And there's a number of different ways that those can be treated, whether the growth happens before you turn on the annuity or after you turn on the annuity. And when I say turn on the annuity, I mean turn it into an income stream. It's not just a lump sum of money sitting there, but you've annuitized it. So in this case, your growth is based on the index growth of some market index. The variable annuities, you're just investing in the stock market themselves. There could be mutual funds. There are certain funds associated with that annuity that you have an option to invest in. Now, I don't talk too much about these. You got to be licensed for securities to be able to do that. And I have no interest in being licensed to get your money exposed to the stock market. That's not my space. My space is the insurance space. We like to deal in the safe money space where it's not at risk to the downsides. So we focus in the fixed annuity and the equity indexed annuity. And there's thousands of products just in those two spaces alone without having to risk our money in the market. Now, there could be some valid reasons why you might want to get a variable annuity. I'm not going to go over that in this video. In my experience, if we're going to get market exposure, we should just be in the market itself. We have a wider variety of options, less expenses, and there's different tax benefits as well. I'm not sold on the tax benefits of annuities in relation to the stock market. The other annuity options give us good alternatives to actually being in the stock market. It might be upside potential with downside protection, similar to our IULs, our Indexed Universal Life. Or it could be we're just going to turn it into an income stream right away. Or maybe we're going to turn it into an income stream within the next 10 years, and we want to have a guaranteed growth that happens throughout that time, and we know what the payout is eventually going to be. So there's reasons to utilize these annuities without having risk of stock market losses. Let's shift back over to the qualified and non-qualified annuities. And I'm going to give you my opinion on where I like to see an annuity fit into a financial plan. And this is just general because circumstances may dictate something else. When I listen to people talk about annuities, other advisors, and I'm doing my research and learning about these things, there are so many advisors that say there's no reason to put an annuity inside of a retirement account. Your retirement account is already tax deferred, and there's not a reason to use an annuity, which when you put your money into an annuity, it gets tax deferred. Why would you do that? Why would you have a tax deferred vehicle inside of a tax deferred vehicle? Doesn't make sense. At its base, I agree with that. That would not be the reason why we use an annuity inside of a retirement plan. The reason has to be different. It has to be different than that because we're already getting the tax advantages of the dollars inside of that annuity. Now, outside of the retirement plan, if you have a need to have a product that defers that income, defers taxes on that growth, but you'll only pay taxes once the income starts to come out and you'll pay it over time, an annuity could be a good place outside of your retirement account. Inside of your retirement account, where I like to view the use of the annuity is as an income option. We're going to also look at the annuity, because I like to use the equity index and the fixed annuity, we're going to look at it as an alternative to having the money in our retirement accounts at risk in the stock market. We're going to lock in some guaranteed growth or guaranteed payments, future income, or downside protection in the case of the equity indexed annuities. So when I first started in this space, I was working in the educator market, and we're generally working with teachers that are within 10 years of retirement, and all of their retirement savings is at risk in the market. Well, the closer you get to retirement, the less you want all of your retirement savings at risk if the stock market were to drop 50%. You don't want to see your retirement cut in half practically overnight. So how do we address that? We try and move some of the money outside of the stock market risk and into something safer and potentially help meet the income needs in retirement, because we know we're going to be utilizing at least some of those dollars that we've saved up in our retirement account as income to live on in retirement. So it's a great time if we're within 10 years of retirement, and you don't have to be an educator. If we're within 10 years of retirement, we really want to start thinking about how to not have as much exposure to the downsides of the market. Now, I'm not going to tell you that means you move every single dollar that you have saved up into an annuity. I don't think that's the right answer. I don't think the government agrees with that either. I think there's laws that have been put in place because unscrupulous salespeople have talked unknowing consumers into purchasing way too much in annuities, committing too much of their dollars into an annuity. And annuities, like, we lock up our money in there. We don't want to commit money that we need to be liquid into an annuity. Most annuities, we're going to lock that money up for a decade or more. So we're not going to want to do that with every dollar that we have and run away if anybody tries to tell you otherwise. At least get a second and third opinion. So inside of our retirement account, there is a need to have that guaranteed income at some point in the future that's going to help us meet our minimum dignity floor throughout retirement. I like to utilize annuities inside of the retirement accounts, not for the tax deferred purpose. We already get that tax deferral, but we like it because we're reducing our risk. We're reducing what's at risk in the stock market. Now, I'm not a hater of the stock market. I do sell life insurance. I do offer annuity products, and I know it's very popular for people that are in that space to try and turn you off to any other investment. You should only do this because that's what I sell. You should only do this because that's what I know about. We don't like to do that. We have a broad knowledge. I like all the different investment options. I do think that there's a place for them, but what's the right ratio? How much of my net worth should be in my retirement accounts, and how much should be in real estate, and how much should be in my whole life policies, and how much should be in my index universal life policies, and how much do I dedicate to future income needs? How much do I put in my annuities? The answer is going to be different for everybody. A lot of it will depend on where you live, what type of expenses you're going to anticipate, how much do you actually have saved, how much can we afford to risk, what's your personality type? Maybe you're less risk averse and you appreciate having something that has a lot more guarantees with it. So all these things will play a factor. Where I like to view the annuity, and we're going to look at this when you get to see my annuity that I bought in a future video, but where I like to see the annuity used is inside of the retirement accounts. Outside of retirement accounts, there's so many things I can do to invest in, including funding my life insurance, which I'm very, very fond of. I love the life insurance products. The high cash value products that we design are excellent, excellent places to store our money. But I don't anticipate turning those into income streams necessarily. I could at some point in retirement, take money out of those and turn it into a single premium immediate annuity. I don't anticipate doing that, but I could. So what I look at is money outside of retirement plans. I usually look at it as meeting some other type of need. There's other investment options. I like real estate. I like having money invested in real estate. We can use leverage there. I like buying life insurance policies because I think it's a great place to store our cash when I'm not investing it elsewhere. It's a good place to store my cash. I like using it as my infinite bank. So that's what I look to do with after-tax dollars. Well, I have dollars that are tied up in qualified funds, qualified accounts. We're pretty limited on our choices there with what we can do. And most of those choices revolve around the stock market. It's the easiest thing to do with our retirement accounts. Now, there are some retirement accounts that will allow us to do other things, and I happen to own one of those. I can use the funds in our retirement account, and I manage it. It's a solo 401k, and I can use those funds. I can loan that out to people. I can go buy real estate. I can do all kinds of other investments if I wanted to. But it's a lot harder. It takes more management to do all of those things with that retirement account. And so the easy thing is to just put it in the stock market. Well, I'm okay with that. I'm okay with having some money at risk in the stock market. But I anticipate having quite a large amount of money inside my 401ks over the next decade. I like to dedicate a portion of that to my future income needs with an annuity. And I will tell you more about that when I tell you about the income annuity that I purchased recently. Now, your plan may not meet that. You're going to have different needs. But hopefully this gave you an idea of the different things that are available out there so that you can start to think about maybe some other opportunities that maybe were not on your radar before. Now, the only other type of annuity that I really didn't talk about are multi-year guaranteed annuities. Those are available. They're similar to CDs. We'll usually lock those up for 3, 5, or 7 years. So you get a multi-year guarantee. You know what the interest rate is going to be credited for that time period. And those are usually really good numbers. You usually get a little better interest rate than if you were to just put that money in CDs or a money market account, something like that. So there's some good alternatives in that space as far as annuity products go. Those aren't most of the ones that we're used to hearing about or talking about. And I don't usually use those in our planning, but there can be a place for those as well. So hopefully this information helps you better understand a little bit about annuities. Like I said, this is Annuities 101. There's going to be a lot more information about annuities that you can find out there. There's some really good educational material out there in the podcast space. If you'd like to meet with me and talk about a particular situation, you can do that. Schedule a meeting with me. Use that Calendly link below. We meet via Zoom. I'm licensed in almost every state, and I'm happy to help you with whatever your financial needs are. Thank you for joining us, and we'll see you next time. I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.